Welcome back to the second hour of the Big Money Show. I'm Jackie DeAngelis, along with my sensational co-host, and with us for the second hour, Fox Business contributor Marcus Lemonis. We're so glad to have you. So some data out today shows that America added 178,000 jobs in March, almost tripling expectations. Healthcare leading the charge again, and as President Trump's Invest in America push takes shape, construction jobs are growing and manufacturing is starting to see a turnaround while the public sector shrinks. Also, some progress on affordability. Average hourly wages are up 3.5%, outpacing inflation over the last year. The White House says the economy is strong and Americans are starting to notice.
It's an exciting time for this American economy. And, the president has done exactly what he promised he would deliver on. And now the people are feeling it on the ground. It's all the investments that these companies have made and the commitment by this president and the hard work that the Labor Department is doing to make sure we close that skills gap and those manufacturing jobs start to continue to tick up.
You know, Taylor, as I was coming in for the day, just given the volatility we've experienced as a result of the war overseas, I took a pause. And even with the jobs number coming out, I thought, it's nice that there's no trading today.
No, Jackie.
No, it is.
Yeah.
It is.
How am I supposed to read the report when I don't know how equities are trading?
It's nice to just take a deep breath and let everybody get grounded, given everything that's going on. But if the market had been open today and you had your crystal ball, how do you think investors would have looked at this? Because there's a couple of things that you can consider. It's positive for the fundamentals of the economy, but we're also watching rates. And you don't want something... they're Goldilocks numbers with these numbers. You don't want things that are too hot and too fast, because then that creates a problem for rate cuts to come.
Well, I have good news for you. My 10-year yield is still open for trading, even though my S&P 500 is not.
Well, let me question the liquidity of that contract. Like, how many people are trading it?
Very
You don't
thin
know.
market
You think
today.
hopefully everyone's in church for Good Friday. All jokes aside, Jackie. Okay. Curveball. What if we don't get a cut this year? If inflation isn't as low as we think and we're adding jobs that's accelerating, if you take out the healthcare strike, remember, normalize that. And I said my 3-month average is 68K jobs a month. What's our net? 20,000? Like, what would be even, Brian? 20,000 a month? So if I'm growing above what's needed to keep an unemployment rate steady, and I'm higher than a 6-month or a 12-month average, and I see acceleration in the job market, and inflation print next month that likely will be higher than expected. One print, I know, just one. But after rents coming down, Brian, I don't see a lot of case for a Fed to come in and say, you know what, you're right, let's cut. If this is as strong as the market as we think it is.
So what are you calling for, a rate hike?
Nope. Steady as she goes.
I mean, I listened to everything you said, and I tried to pay attention, but I couldn't get off the fact that you said, what if there isn't a rate cut? I'm surprised you're still asking that question. There's not going to be a rate cut. Why would there be?
Well, I think all of them think there will be.
What's the justification for it?
I think there will be later.
Why?
This year.
Yeah, tell me why. I'm with you.
I'm looking at this and saying when everything normalizes, I wasn't expecting this number today. So if this continues, everybody I've been talking to has been saying that they think the jobs picture is going to get better, which is sort of the antithesis of the expectation that's out there. I wasn't necessarily anticipating it. So I'm thinking to myself, if the conflict ends, if oil prices come down, if any perceived inflation rise normalizes, and labor stays the same as it was before this month, plus we could get revisions next month, you might still be able to make the case later in the year that a cut would be warranted. I'm not saying cut at the rate that the president is suggesting, but it's possible.
You're going to have tariff clarity?
GDP's at a very low 1.6%. That adds that case.
War's over. Are we going to get tariff clarity? To me, nobody's answered that. We haven't talked about tariffs in a couple of weeks, appropriately so with the war. But what happens with tariffs in the back half of the year?
You're getting your 301s and your 201s and your 122s.
Well, this morning something came out because I got a text message that we're going to get a huge refund on some steel that we had to bring in. There's apparently some sort of rebate or refund that's going to happen on steel. But I think a lot of it is the war's going to end, hopefully, soon. Tariff clarity, hopefully, soon. jobs still doing well. Is it a stabilization or is the economy strong? And I think that was the one part that I got a little annoyed about. When the economy's not strong, it's stable. Stable is good. Stable is really good.
Yeah.
We just have to stop exaggerating as an administration because voters at home know that it's not strong.
Well, go ahead.
No, I'd say I would trade a strong economy and signals of a strong economy for a rate cut all day long. I have gotten so sick of the Fed being at the center of every economic conversation.
Yeah.
I'm so tired of an economy and a market that hinges on are they going to cut or not cut. And I want a strong economy. I want to finish this war successfully, see energy prices come back down. I want to see the government get a handle on its spending, and I want to see the 10-year come down where it needs to come down because you've taken risk out of the market, but not so far that it suggests you've got a weak economy, right? A strong economy is going to give you higher yields, and I don't mind that so much, but I really, really want the Fed to not be the focus of this economy, because that is not the real economy.
Rates do impact growth. So the borrowing costs for these companies, it will impact how quickly they can expand and grow. When the rates are higher, presumably they can borrow less. We've talked about a sweet spot of being able to have, the company prosper, the interest rate on your mortgage kind of be in a sweet spot. We're not saying it's got to be zero because that's artificial and not really realistic long term.
But don't you think we've gotten into that? Like, part of my problem,
I don't know. We could be there.
It's like that context that we had for so long of 0% rates, 3% mortgages. Like, that was so unrealistic. The historical benchmarks for things like mortgage rates are not 3%, right? And that's like fixed in our heads. I'm not saying I want it to be high, but I'm saying we're not in crazy land on interest rates right
but
now
is
with a
it 6
strong
and
economy.
change, right? If it was somewhere in the 5s.
That's what I'm saying.
There's this wiggle room that I'm looking at.
Which we touched the other day. We touched high 5s on mortgages, and then the war
Right, and then the war started.
Right? So, I mean, we're not far, in my view, target.
Now what was it yesterday?
So we're like
now
6.5?
It was close to 6.5.
Yeah.
The Fed needs to cut rates and will have to cut rates because of U.S. borrowing. That's why rates have to go lower.
There's also
because
that.
our interest expense is becoming out of control.
That's not one of the factors they consider.
Well, absolutely they do. They will never admit it, but a third of our debt has to roll in the next year, roughly. And to keep borrowing costs in check. So it started under Janet Yellen, but has maintained under Scott Bessent that the schedule of borrowing is weighted on the short end and it's very short,
Wouldn't it
like
be
under a year. And it's so short that some of our debt, it rolls more than once in any given 12-month period. So, yeah, that's what the Fed can control. Beyond the next step would be, because the market, the actual investor market will move against you, which is what's happened during the war, is that they've been demanding a higher rate of return for holding longer term debt. So longer term interest rates have gone up because we're so deeply indebted. And they're expecting investors more supply from the U.S. government to fund said war and defense spending, if you look at Trump's budget. So first, the Fed lowers rates to finance the debt on the short end. The next step would be, and they already are buying about $120 billion in expanding the balance sheet. The next step would be really blowing out the balance sheet to buy our debt, because we can't find actual natural buyers in the private market at a decent rate.
Doesn't it make the independence of the Fed then laughable, that you could spend too much, borrow too much, and then, you know what, I'm going to adjust my rate to make it more affordable for me?
Well, that's why I call Jay Powell the other day a Tony Fauci-like spotlight-seeking clown show. Because what he did during the 4 years of the Biden administration, they were borrowing money hand over fist on the fiscal side to spend it on God knows what. We don't know where the money went. And then Jay Powell blew out the balance sheet by $5 trillion to sop up that debt. So there's no independence.
That, by the way, just if you want to read economic history, I'm not disagreeing with you, but that is exactly how uncontrollable inflation in countries starts. monetizing debt like that. Like that's all that is printing money to cut the government's borrowing cost, which is
Yes.
a hyperinflation instigator.
Right.
By
I'm not
definition.
saying it's happening.
Yeah.
And that's why higher oil prices right now are not causing inflation. Inflation is a monetary phenomenon. And also, if you look at, like, just in the last week, to bring it back to the energy inflation story, oil is still up notably, but other commodities are completely in check. Natural gas, Newcastle coal is 1.5% gain in the last week. It is not the catastrophic energy crisis that you would see in other scenarios.
And the metals have corrected somewhat.